Welcome to Wealth Preservation Solutions. I'm Elizabeth DeLeo, Director of Family Offices. Kevin Ellman, CFP, our CEO, is here with us today. Hi, Kevin.
Morning.
And we are joined by who is now officially a recurring guest, Kara Murphy, who is the Chief Investment Officer at Kestra Investment Management. Good morning, Kara.
Good morning.
It's great to have you as always. And before we started to record, we were just chatting about our Thanksgivings. And now is the time of year that most Americans were gathered around the table last week, proclaiming what they're thankful for, maybe setting goals for the following year as a family or individually. And undoubtedly, one of the things that I know came up around my Thanksgiving table is how much more groceries were this year to put the turkey on the table. And so today's topic of discussion is very relatable to that, in that we are speaking about inflation. We're going to spend some time to learn what areas we believe are permanent, what areas we believe may be more transitory, and then how that view may impact the stock market and economy. So Kevin, each day as we're doing reviews, clients always present key questions to us. And the theme as it relates to inflation, as you were explaining to me earlier, is that they want to know if this inflation is going to have a negative impact on the bull market. So can you just spend a few minutes and give us your outlook on that?
Sure. So I would say this last few weeks, the number one question we're getting is, do you think inflation will stop the growth of the stock market and send us into a recession? So I'll just say the conclusion right off the bat is I don't think inflation is going to be bad enough to send us into a recession. Having said that, I do think there will be parts of the economy that will see maybe permanent or long-term inflation, and others where I think it's going to be temporary. So at the moment, I don't think there's cause for panic. And of course, this is something we're watching all the time. And, I'd be interested to hear what Kara's take on all this is.
Oh, so is that my prompt? Okay.
That's cute.
Yeah, so we are very much in the transitory camp, and that when we look at different types of price increases, we think it will revert back to a more normal level. Now, the definition of transitory has changed a bit. Like when we started these conversations earlier in the year, transitory meant like a quarter or two. Now we're looking at like year and a half, as we're seeing that the supply chain is taking a lot longer to kind of resynchronize. But the key reason why transitory versus non-transitory is important is because it will impact how the Fed reacts. And how quickly the Fed withdraws stimulus then has all sorts of implications for the economy, for the market. So as long as the Fed believes that prices will in the not too distant future return to a more normal level, then they don't have to be super aggressive in withdrawing liquidity.
So I think you make a good point. And to me, it's helpful to think about which parts of the economic equation will show, permanent price increases and which will be more transitory. And one area which I think will stick is wages. So I think everybody's experiencing difficulty finding people to work for them. And as a result, they have to raise wages in order to keep people, raise wages in order to attract new people. And I know ourselves, we're actually trying to hire some new people. We put in an ad, and a couple of years ago, we put an ad and we got 100 responses. This time we got 3.
Wow.
So the market for people working has changed dramatically. So I think that part will stay permanent. And that's good and bad. I mean, on the one hand, it affects company profits. On the other hand, it does put money in the pockets of families so they can go spend. So it's kind of a double-edged sword. It's good and bad.
Yeah, and I think the wage picture, what's happening in the labor market right now is really fascinating. And we've been spending a lot of time on it, partly because I just find it very interesting, but it has really important implications for the broader economy. So wages are one of the areas that once you start to see price inflation, it does remain very sticky, right? So if you have to spend more, if you have to offer somebody a higher salary in order to come on board, if prices then start to turn down, you can't lower their paycheck, right? So those levels are kind of in there to stay. But when we break down the areas of the market that have seen the largest wage increases, we can look at it by level of wage. And so those folks with the lowest wage levels are the ones who have seen the largest increase in wages. Now, typically that segment of the population tends to have larger swings. So in economic growth cycles, they tend to see larger wage gains on a percentage basis. And then as the economy turns down, they tend to have larger declines. Those types of jobs also tend to be more centered in service industries. So as you think about what happened in COVID last year, those are your bartenders, your servers, your hairdressers, who overnight their jobs just vanished. And those are also the industries, travel industry is another one. Those are also the industries that are having the hardest time hiring, right? Because their workforce went away overnight, and they're having to spend more money to attract those folks back. They also, they tend to not have benefits. They tend to have irregular schedules. So a lot of folks, when they have an opportunity to move to a more stable industry, a more stable income, they've taken that opportunity. So that's where, again, it's not just this kind of like price level, but people are making kind of life decisions to retool and to move into other types of industries. So the other interesting phenomenon that we've seen is that the largest wage increases have also been among those who have left jobs, and mostly among those with a high school degree or less. So if you have a high school degree or less and you've left your job, you are likely to see the largest percentage increase in your wages versus somebody with a higher wage or higher education level. So something to keep in mind. So far those wage increases have been relatively concentrated into among our lowest paid workers. And one other thing that I would add, which I think is important, because you mentioned this, Kevin, how consumers have more money in their pockets when wages are higher, but companies have less. Corporate profits right now are among the highest that they have been in decades. So if there were ever a time for companies to be able to absorb higher wages, now would be it. So I think companies are coming into this. I mean, it's still hard to hire, and that can be very frustrating as a business, but companies are actually in among the best place they've ever been to be able to pay more to bring workers on board.
So I think that's really the number one point, that we think in terms of the economy and the stock market. And what is the economy and the stock market? It's made up of all these companies in America.
Sure.
So as you say, which I believe is true, most companies are having banner years, and I know we are, and I know many of our clients are, depending on the industry. Then that reflects well and bodes well for the stock market. So
For sure.
yeah, I mean, I think our basic outlook is that 2022 is going to be a positive year. I don't think we're going to see the kind of gains we've seen in 2021, but I think it's going to be a positive year. And I don't really see anything that is likely to dip the country into recession. Another area which I think is more permanent, I've been reading, is that rents seem to have crept up, and rents are not likely to be adjusted downward next year or the year after. Typically, once a rent is put in place, it's going to stay there.
Or
So
go up.
what have you learned about what landlords are doing?
Yeah, and I would expand that even to be more generally housing. So housing in general has really gone up, whether it's house prices, condo prices, or rents. And this is another area of the economy, like once you start to see price increases, they tend to be more sticky. And in fact, the measures that we use to identify price increases in housing tend to lag actual price increases. So I'm going to get a little technical for a moment, but again, I'm the data geek, right? So when we use the consumer price index, so typically when we talk about inflation, we use the consumer price index, or CPI. A very large portion of that CPI index is housing related prices. About 40% of that overall calculation is from housing. So it's a really big, important driver of overall prices. A good portion of that is what we call owner's equivalent rent. So they basically call up homeowners and say, if you had to rent your house, what do you think you could rent it for? And somebody's like, I don't know, 2,000, like, I don't know. So people are guessing. And so it tends to be a real challenge to identify what those rental prices would be. And also, like I said, tends to lag actual prices in the market. So we're seeing that landlords going out there, other measures of like rents, for instance, are showing much larger increases, but it's lagging in the CPI data. So I would expect that alone is just going to take a number of months to sort of like catch up with where we are. Now, that said, low interest rates continue to support this increase in house prices, because the amount that homeowners are paying has gone down because mortgages are so much more affordable today. So again, it's the double-edged sword.
Yeah, I got a call this morning as I'm walking the dog from one of my clients who is refinancing his mortgage and is lowering his rate by 1%.
I
So
mean,
even
it's
though
incredible.
maybe
Yeah.
the owner's equivalent rent is going up, he's going to be spending a significant amount of money less per month because he's
Yeah.
able to refinance at still low rates.
Mm-hmm.
So even though prices may be going up, rates really haven't crept up that much. So mortgages are still extremely low. So let's shift gears and talk about some of the areas that are perhaps more transitory.
Mm-hmm.
So we also have quite a few clients in the car business, automobile.
Oh, interesting. Yeah.
And that's been an unbelievable year.
Yes.
The automobile dealers, they can't get cars because they can't get, in many cases, computer chips.
Yeah.
So they're really suffering with the supply glitches. And as a result, they're selling cars for top dollar. Used cars are getting top dollar, and they're having the most profitable year almost ever. But that's not going to be forever. So as the supply chain starts to open up, they're going to get parts, they're going to get cars, prices are going to normalize. And that's a big ticket item. So that's an example of an area that's going to normalize, in the not too distant future. And I think every other area of the economy that's really dependent upon, the supply chain, which is certainly, groceries and furniture and many other things like that, clothing.
Mm-hmm.
Those will, I think, normalize over the next year. I agree with you. I don't think it's going to be the next month, but by the end of 2022, I think we'll see things normalize. And I think the point you made is the number one point, which is the Fed will probably be able to wait before they raise rates.
Mm-hmm. Yeah, and it's been interesting to see because you can almost track like those types of goods that were affected very early because of supply chain issues are the ones that had enormous price increases, but enough time has passed that we're starting to see those prices retreat again. And so that gives us some confidence that this transitory is actually playing out. And you mentioned autos. So that was a very early impact on prices. And so think about like kind of what we went through a year and a half ago, where you had all of a sudden very, very quickly, everybody had to shelter in place. You had a lot of folks living in cities who were like, oh, I need a car to get out of here, right? So you had this rush of folks buying more cars. So demand actually increased just at a time when supply was decreasing, right? And that's the challenge that we ran into. And then you mentioned the chips, which we've talked about before, where you have like a car that's 95% built and you're waiting for 3 very simple chips, but you can't drive it off the lot until you get that. So there's some very unique challenges. So like when we look at used car prices in particular, massive increases in prices. In fact, the fastest price increases we've seen since we started tracking that data, but they've started to retreat already. Now, again, there are still supply chain issues. Those cars are still waiting on lots for their chips, but we started to see demand come down and people maybe being scared away by high prices. And so those overall prices are coming down. Another good example is lumber. So very similar in that fairly early in COVID, you had people who were like looking around and be like, I need a bigger house. So they either like wanted to build additions or buy a new house. So there was a higher demand for lumber just at a time when some of these mills were shutting down. There was an impact on supply. Huge increase in lumber prices. Lumber prices are now down like 60% from their peak, right? So you're starting to see that roll over. So some of these early things, it's playing out as we would have expected in a transitory environment, but that doesn't mean it's over.
So everything you're saying so far reinforces the point of view that I developed so far, which is that, yes, some parts of the economy will see permanent price increases, but I think probably a greater slice of the economy will see softening prices the way you've mentioned. And therefore, I'm maintaining my outlook that I do not think we're going to roll over into recession. The only thing I'm a little worried about is this new variant. Is it Omicron or Omicron?
Yeah,
And,
Omicron. Yeah.
I mean, that's an issue and that could hurt. But as far as inflation is concerned, I don't think that's going to be bad enough to dip into recession. I think the Fed will stay, soft. And I think we'll continue to see a positive year next year. So how does that dovetail with your point of view?
Yeah, I agree. And I think like one risk that I think people are not paying enough attention to is the idea that prices could actually turn around very quickly. So think about, I don't know about you guys, but like for 2 months now, I've been getting calls from the grandmas about Christmas wish lists for my kids, right? And so both have gone out like super quickly, did all their Christmas shopping because they were worried about these supply chain issues, right? So I think in some instances, buying has actually been pulled forward from its normal cycle. In other cases, people have put in multiple orders, like not sure which one was going to arrive in time, and then I'll just return the other ones that come in. So it's very possible that over the next couple of months, stores could end up with more inventory on their shelves than what they had forecast, just because this situation is changing so quickly. So that is something that we're paying very close attention to too, where we could actually see prices in some of these goods drop quite dramatically. So something to keep in mind.
That had not occurred to me.
The return season should be extra busy this year.
Right? Yeah, for sure. Now, one other thing I wanted to mention too, because you're thinking about the overall impact on like the economy and the market. There are a number of other factors that we look at that tend to give us a very good signal about where we are in the business cycle. One is the yield curve. So the difference, I look at the 10-year yield versus the 2-year yield when we look at treasury bonds. If there's a big difference between those two, that indicates that the market is expecting the economy to continue growing. Once those two things shift, short-term rates actually end up higher than long-term rates. That's a signal that the market's about to turn down. Right now, we're here. So, it's come in a little bit from where it was, but the yield curve is still telling us that there's a lot of growth in between there. Another factor that we look at is the Institute for Supply Manufacturers Manufacturing Index. So they call up companies every month and say, is business better or worse than it was last month? So it's a very quick pulse on what's happening in the manufacturing sector. And it has a very good track record of identifying turning points in the economy. And right now we're in very, very strong levels. So again, off the highs, but but indicating very strong economic growth. So that's just a sample of the couple of things that we look at and I've used throughout my career that continue to tell us that the economy is in good position.
So when you said the grandmas, I thought maybe is that a new marketing company?
Yeah.
I know about? Grandmas.
They should.
You should. Grandmas Unite.
Yeah.
So I'll put a tag on that. So basically, what's the conclusion? So the conclusion for us is we're going to stay the course. We don't want to change our allocation. We certainly want to be very careful about bonds. I mean, we don't really think there's going to be runaway inflation, but we do think rates will probably creep up a little bit. So, it's not a great place to be investing. And we're happy being invested in the stock market. So we're going to continue with our outlook, continue with our allocation. And of course, we're going to monitor conditions. And if something changes, then we'll change accordingly. But right now, we're happy where we are. We're going to continue and stay the course. Elizabeth?
Thank you. Kara, do you have any final thoughts that you would like to share with us?
So again, like I feel good, similar to what Kevin said about where the economy is. I think the market also has really strong dynamics. The one thing that gives me pause is valuations. And we've talked about this before. Valuations are high relative to historic measures. And because of that, I wouldn't be surprised to see the market kind of churn sideways for a little while, which I think would actually be a very healthy outcome. Allow people to take a breath, allow earnings to kind of catch up with prices. But in general, I think the economy is still in very good shape.
Great. Kara, thank you, as always. And Kevin, thank you. For those watching, as always, to learn more, visit our website, wealthpreservationsolutions.com. We look forward to seeing you next time. Until then, stay happy, stay healthy, and stay wealthy. Bye.
Bye.